Looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some Ask James questions of the day. Our first question from Donovan asked James, you mentioned getting 6% income as an example. You just said that long-term government bonds are now under 4% though. So how do you get that 6% number and how do fees affect the income? Perfect. All right, let's jump into it. Remember, U.S. Treasuries have no risk. They have zero default risk. Now they have inflation risk and things, but zero default risk. Unless you think, that we have a chance of defaulting on our debt, right, the government, which I guess is possible considering we can't even balance our own budget right now. But anything's possible at this point. But assuming no default risk, keep in mind that most people are coming out of stocks and a lot of people are coming from growth stocks and riskier stuff, technology, right? So you don't need to go all the way from the frying pan into the freezer, right? From a lot of risk to zero risk. There's a bunch of things in the middle that generate income that have some risk, but are considered a heck of a lot more conservative than the overall stock market, especially growth stocks. Now, the key is understanding that there's a whole spectrum of risk and return between government bonds and equities. And that's where we can find opportunities to boost your income while still maintaining a conservative posture. So, for example, just by going to corporate bonds, right? Now, there's all different grades of corporate bonds that you can, get more interest from. And just like we have a FICO score as individuals, and when we go to a bank to get a loan, the interest rate that, we'd have to pay on the loan depends upon our FICO score, our overall credit score. The higher it is, the lower the interest rate, the lower it is, the more interest. So by gauging that properly, you can still get into things that are fairly secure, but pay a lot more than 4%. Investment grade corporate bonds from solid companies with strong balance sheets might give you an extra 1 to 2% over treasuries. And you're still dealing with quality companies that have been around for decades. What you can also do is get into, other what I call bond-like instruments. So for example, you can get into preferreds. Right? Now, preferreds are technically a class of stock, but frankly, they're more bond-like in many ways. When they declare a dividend, that dividend is fixed. Essentially, if they don't pay the dividend, it's considered, for most, like a default, like a bond. Now, preferreds pay a little bit more than the equivalent or similar bonds, so that's good. But they sit, higher in the capital structure than common stocks, which gives them an added layer of protection, and many of them are issued by banks and utilities, stable, regulated businesses that generate predictable cash flow. Then there's other, bond-like instruments. There's the ability to get into things like business development companies, which essentially make loans to medium-sized companies. All a bond is a loan. And that makes, and this makes loans to medium-sized companies. Now, so these BDCs often yield in that 8 to 10% range, though you want to be selective and understand what you're getting into. And then, you get different stocks that can pay higher dividend, a higher income component. Think about dividend aristocrats, right? REITs that own income-producing real estate, or utility companies that have been paying dividends for generations. These aren't speculative growth plays. They're established businesses with proven track records of generating cash and returning it to shareholders. So when you put all those together in a healthy, diversified mix, yes, you can get 7% before fees, 6% after, which, like I said, if you take 4%, that means you have an automatic built-in 2% reinvestment inflation hedge. Now, regarding fees, it's critical to understand that not all fee structures are created equal. If you're working with an advisor who charges 1% annually, that comes right off of your income, which is why starting at 7% gross is important. But here's the thing. A good advisor should be adding value beyond just that 1%. They should be doing the research, monitoring credit quality, rebalancing when needed, and keeping you from making emotional decisions that could cost you far more than 1%. The goal is to build a portfolio that generates reliable income you can count on regardless of what the market's doing on any given day. Important and a great question. And if you'd like to send in your question, you can do so. You can email your question to Poole Locke at poolelocke.com. All right, we'll move on to our second question, and this is from Kelly. Now she says, dividend stocks tend to do well in a lower interest rate environment. Now, James, you mentioned this. I just don't know how I can choose the right dividend stocks. Okay. Kelly, well, it sounds to me like you're what I call a do-it-yourselfer. You love to manage your own money, and that's great. Except my answer would be, you may not be able to when it comes to dividend stocks. Dividend stocks are one of the most difficult things to do in the investment world. Choosing bonds and bond-like investments is a challenge, but it's basically doing credit analysis with the company. So a lot of people are good with numbers, or, if you ever, worked at a bank approving loans, this fits right in. Now, the problem with bonds and bond-like instruments is how do you buy them to get a fair price because they're negotiated, right? So you may need a professional to help you negotiate the right price, just like when you buy a piece of real estate, you have to negotiate it. It's not like a stock where you just push the button. You know what the price you're going to get. But the research is a little easier, though. Now, the credit metrics are more straightforward. Debt to equity ratios, interest coverage, cash flow analysis. These are quantifiable things you can kind of wrap your head around. Growth stocks, same thing, right? And they're easy because growth stocks, capital appreciation stocks, have momentum, right? They're going up. They're going up. Tech stocks are hot, right? So you buy tech stocks. You ride them up. As soon as the trend reverses itself, you sell. Maybe you put in a stop loss so that it sells automatically. Now, in a momentum game, and while timing matters, the strategy itself is pretty clear cut. You're following the trend, riding the wave, and getting out when the music stops. Dividend stocks are the hardest, and here's why. Anything that's growth-oriented isn't going to pay a high dividend because they feel like they can reinvest their profits in the company to grow the company internally. And that's more important than paying a dividend to the shareholders. So by definition, when you're paying a dividend to the shareholders, you're investing in a company that's in the mature part of the life cycle, the corporate life cycle. Well, there's different parts to the mature portion. There's the beginning, the middle, and the end. And if you get to the end part of the mature life cycle, well, then guess what happens after that, right? The decline. So think of all the great companies that have been great and then declined or disappeared. In fact, the 30 biggest companies in the Dow Jones Industrial Average just 100 years ago, none of them exist today, right? They all went bankrupt or got taken over, right? These are the bluest of blue chips in their day, household names that everyone thought would last forever. But industries change, competitive advantages erode, and management teams make strategic mistakes. So you have to ride that knife's edge between those that are mature but still have some growth potential versus those that are mature and might go into decline. As an analyst, we call it value versus value trap. I got a buddy, he likes to buy things cheap. And sometimes he confuses value for the value trap. Right? He buys something because the price is cheap. And then he's got to put more money into it to support it. And it becomes a losing venture, right? Versus buying something that's a little more expensive, but a good value, right? Where over the life of holding that particular asset, it costs you less. You can buy a boat, airplane, same thing. You can buy a boat or an airplane at auction, it's really, really cheap. And then you have to put a lot of money into it to keep it up. Same thing with stocks. So you can get something that's a value or something that's a value trap, which means it's probably going to have declining profits, which means they're going to have to cut the dividend eventually. And when they cut the dividend eventually, the price then goes down and it becomes the corporate death spiral. The stock gets hammered, income investors bail out, and suddenly you're sitting on a position that's down 30, 40, 50%. And the income you were counting on has evaporated. So that's the tough part, kind of in order to differentiate that. You can't just look at the financials of a company. You have to look subjectively about the direction which that company's heading, where they are in terms of market share in their industry. Look at the industry as a whole. Are they gaining share or losing it? Is their industry growing or contracting? What are the competitive dynamics? Who are the new entrants that might disrupt their business model? And the only way to do that is by talking to lots of people, analysts who know what they're doing, talking to the shareholder services at a company, knowing what questions to ask. You need to understand the payout ratio. Are they paying out 90% of earnings, which leaves no cushion, or are they paying out 40 to 50%, which gives them, room to maintain or even grow the dividend during tough times? So again, I don't like to say it. I know you love to do it yourself, but this may be something that you may not want to try alone, right? And the thing is, what got you to this point? If you've been really successful with do-it-yourself investing, or even if you've worked with an advisor that's focused on capital appreciation first, it's not going to be the same strategies, the same thing that you need to do once you get into retirement. You have to change that strategy a little bit, to be able to keep up and to really generate the income that you need in the accumulation phase. You can afford to take more risks, ride out volatility, and focus purely. You can't afford to do that anymore if you're just if you're only focused on growth. But in retirement, when you're depending on that income stream to pay bills, right, you really can't afford to have your dividend cut or watch a position crater because you missed the warning signs. Arguably, even if it weren't as difficult as dividend stocks, determining value versus value trap, you still have to ask yourself, if this isn't something that I've ever done before, I can go get a lot of textbook knowledge and I'm smart enough to do it myself, but without real world experience, is it really worth my life savings? Are you willing to learn these lessons with money you're counting on for groceries and healthcare? There's a big difference between knowing something intellectually and having the kind of battle scars from making mistakes and learning what actually works in real market conditions. The alternative is you can work with an income specialist. We would be happy to explain the strategies that you can use to generate income. We live and breathe this stuff every day. We have relationships with research analysts. We've seen multiple market cycles, and we know, how to build diversified income portfolios that can weather different economic environments. So if you're looking for more information, you can always reach out to us. Hey, great questions today. If you have a question that you would like answered, send it into the show. Email it to us. You can email them to Poole Locke at PooleLocke.com. And if you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source.
Money on my mind, looking for a dime. dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me